Hello and welcome to your weekly installment of the GoNoGo Show. It is April 26th, Friday. My name is Tyler Wood. I am a CMT charter holder, and as always, I am joined by Alex Cole, the Chief of Charts. How you doing, my friend?
I'm doing very well, thanks.
Hello from a very cold, rainy Minnesota. Alex, let's dive into what's going on with the markets. Looking at things from a trend perspective using GoNoGo charts in our asset class heat map. We're going to look at the absolute trends of multiple asset classes just to get a sense of the overall context. Walk us through this heat map.
Yeah, and so we've seen these trends change, and we saw the rotation for the last several weeks. We're still seeing the no-go trends in equities and treasury bond prices. Mm-hmm. Equities, of course, having a good couple of days, so you can see that we've got weaker pink bars coming into that, but still the weight of the evidence points to a no-go. Mm-hmm. Treasury bond prices in a strong no-go trend. We'll talk about rates in a little while and see how that is an inverse relationship with bond prices. And then the two assets that are sticking with their go trends are commodities and the dollar in these lower two panels.
So we've got, rates rising since February. We've got strong U.S. dollar, certainly some headwinds to a risk-on environment. Let's go over to the full GoNoGo chart of the S&P 500 and just take a look at what that weakness has been showing us. 6-day losing streak, bringing us to those lows. Alex, I'm seeing that GoNoGo oscillator striking a lot of negative momentum and being rejected at the zero line. It seems like we're at a little bit of an inflection point again here.
Yeah, this is what we're going to be really looking at and paying attention to. As I said just before, we are in a no-go trend. We were in this really strong, nice go trend, high highs, higher lows since the end of last year. And we've seen that roll over. We saw it first with the oscillator, failed to find support at the zero line and broke into negative territory. Then we saw an amber go fish bar before we saw go-no-go trend start to paint those no-go colors. So now we've seen a rally off those lows. We are still, though, painting no-go bars, and the oscillator is testing the zero line from below. So the other thing I wanted to point out here is that we've built volume into this oscillator, Tyler. So when prices were rolling over, we saw volume pretty heavy and picking up, perhaps confirming the move lower and some market participation. As we've seen price rally these last few days, that volume has weakened a little bit, lightened off. So take that for what it's worth. We're seeing a little bit less volume as prices rally off those lows. So very, very important to see what happens at the zero line. If the oscillator gets rejected here and falls back into negative territory, then we'd expect the no-go to continue.
Absolutely. Last week on David Keller's show, The Final Bar, we talked about that shift from a go trend to a no-go trend. And Dave had the very logical question of, so, how do you trade this trend model? What does that mean when it goes to a no-go? And I think what you and I have said for years now on these weekly shows is that we're not trying to anticipate the future. S&P 500 could absolutely rally back into a go trend. That might be the next step. But what we do know is that staying objective to and rules-based in our process allows us to avoid what could be potential further downside risk. So when that trend model, when all of the weight of the evidence is in a downward trajectory, we certainly don't want to be long and holding those positions on the hope that it will reverse and come back into trend. Hope is not a great investment strategy. And so using that interplay between the trend and the oscillator to get a sense of whether momentum might recover first, that could be a leading indicator of perhaps some constructive behavior for the S&P 500. Alex, let's take a look at some of those top-level macro influences, cross-asset analysis or intermarket approaches that we all learned well through the CMT program. Let's take a look at U.S. 10-year Treasury yields. This week, the big news with the growth rates coming in for the GDP much lower than analyst expectations of 2.2 to 2.5, depending on who you ask. We came in at a 1.6, and so obviously the slowing of the U.S. economy. These are very lagging indicators when we're talking about large economic data sets. But the anticipation of how the market might digest that information is what we're really interested in as technical analysts. There's the information, and then there's what people do with the information. So a lot of speculation about a slowing of the GDP growth number, perhaps influencing our Fed to begin cutting rates at an earlier point. Let's be objective about this, though, Alex. Where are rates right now?
Rates are in a go trend. On a daily basis, we're seeing a new higher high, strong blue go bars, and the oscillator above zero and finding support at that level. So, like you said earlier, potential headwinds for U.S. equities. Certainly the case. We're seeing rising rates on this daily chart. And we could pop it out to a slightly longer term chart just to keep that in context. We're still not at these prior highs, but we are in a go trend for several weeks, and we did break out of that max go no go squeeze. So there's some momentum pushing rates to the upside.
Absolutely. Let's take a look at the U.S. dollar, which has been another headwind for risk assets. We've seen dollar strength continue despite all sorts of headlines that might position traders to the contrary.
Yeah.
UUP is the ticker symbol we use for an ETF proxy of the dollar index. That allows us to get a sense of volume as well. Alex, we're in a weak go trend.
Yeah, we're moving sideways since we gapped higher just about 2 weeks ago. But we haven't really fallen away too much. We are moving sideways, and we're in positive territory. Of course, the oscillator falling to the zero line, we'll make sure to check to see if it holds that level of support. And if we back this one out to the weekly chart, we can see why perhaps we're still trying to deal with being above these highs from last year. But any kind of consolidation at these levels, like we said on the daily chart, we haven't fallen away too much. We're moving sideways. We're really consolidating at new highs. So quite a strong chart when you back it out to the weekly. We see higher highs, higher lows. We see strong blue bars. And the oscillator, of course, still very high in positive territory.
Absolutely. For fun on your own, viewers, go check out the dollar yen chart. Some big moves in Japan, but we won't take too much of your time on today's show to look at that. The idea being that with any technical indicator, you're going to be using this across all liquid securities in the exact same way. The calculations don't change, and there's some really interesting activity happening over there. Alex, let's move on from the U.S. dollar. Let's check in on U.S. oil. A lot of inflation measures come around to the core CPE number, but we've also seen oil in this rising trend and perhaps picking up after a bit of a corrective phase.
Yeah, we saw this counter trend correction arrow just after the last high, and that told us that price may struggle to move higher in the short term because we were seeing waning momentum. So that certainly happened. We saw a bit of a pullback. But now GoNoGo Trend has shown strong blue bars for the last several days, and that's allowed the oscillator to get back to the zero line. We did dip into negative territory, which of course is a bit of a concern for the Go trend. So we'll see, can we get back above the zero line into positive territory? If we do, then we'll be able to say momentum is resurgent in the direction of the trend, which of course is a go, and we'll see a green circle telling us that we're likely to see some trend continuation.
Absolutely. And let's take a quick look at gold, precious metals. We've talked the last several weeks about the entire commodities complex and up and down the arena. Gold has pulled back. We've seen some counter-trend corrective price action with that gap lower. Tell us the importance of what's happening as we're building that go-no-go squeeze in the lower panel.
Yeah, interesting one to look at here. We'll talk about it in a little bit of the same way we talked about the dollar. We are pulling back, as you said. We saw those counter-trend correction icons, again, telling us that perhaps in the short term we may struggle to go higher, and that's, of course, what's happened. We gapped lower, and we've seen some weakness with these paler aqua bars. But what you're alluding to is that we're at the zero line on the oscillator, and we're staying at the zero line, and that's causing the grid of the go-no-go squeeze to climb. And that tells us we're seeing some reduced volatility in the price action. So it'll be very interesting to see in which direction this squeeze grid is broken. If it's broken back into positive territory, then all well and good for the go trend. What's interesting is that, like the dollar, even though this looks like a pullback, and of course it is a bit of a pullback on the daily chart, if we break this out to the long-term weekly chart we were looking at, you can see how much higher we are than that neckline. So we are certainly, if we are pulling back, we are still consolidating well above the resistance level that it took so long to break through.
Absolutely. And nothing healthier for markets than a little time to digest parabolic gains like that, right? For those of you who are new to the GoNoGo charts, or perhaps you've just added them to your platform, what I think is important to emphasize is that price is our most important indicator of all of the technical toolkit. So we want to keep our eye focused on price action and where that's at. That's what's going to decide our trade activities. But as technical analysts, we want to get an understanding of trend. We want to couple that with an understanding of momentum, and we'll talk about divergence here for just a minute later in the episode. But then volume and volatility are critical importance, have critical importance to the technical analyst, because we're looking at those areas of a tug of war, a crowded trade. When buyers and sellers can't agree, we see that stagnation of the GoNoGo oscillator at the zero line. So that squeeze is just helping us visualize investor behavior at these levels. And so for gold right now, they're waging that tug of war, and we'll see the importance of that GoNoGo squeeze break, because from compressed volatility can come expanding volatility and high velocity price moves. We've learned that from the great John Bollinger and Bollinger Bands, or you might have used Keltner channels before in a similar manner. So that's the important for us. We're looking for those leading indications, and what we're going to do is trade in the direction of the break. All right, Alex, enough of these intermarket charts. Let's get back to the equities markets, but let's get under the hood. We've talked about the S&P 500 moving from a go trend to a no-go trend. That's risk off. We can also get a sense by looking across the sector groups at just where leadership is, and the characteristics of our market are going to tell us a lot when we can see leaders in the consumer staples and utilities sectors. That's definitely a defensive posturing that a lot of investors are taking right now in this recent pullback. So walk us through this relative strength heat map, each of the sectors relative to the S&P benchmark.
Yeah, what we do is we apply the GoNoGo trend concept to the ratio of each sector to the benchmark index, and then you can get a sense of relative outperformance and where the relative go trends are. And we've talked about this rotation over the last several weeks. We were seeing rotation into the middle of the map, which are those sort of more cyclical economic sectors like energy, financials, industrials, materials. And now we're seeing staples adding to that already strong utilities outperformance. So certainly moving away from some of the more growth sectors, and some would say painting a more defensive picture. There's some uncertainty as well surrounding these two sectors that have been outperforming. One, of course, is materials. So we're seeing a couple of amber bars coming back in there, but definitely a slightly more defensive picture than what we've been seeing.
And of course, a lot of attention being paid to large cap tech names reporting earnings this week. Fascinating to see Tesla miss their earnings target, but rally on some forward guidance and comments from Elon Musk. That's a lot of speculative activity around what were the Magnificent Seven that were leading our market higher last year. But remember, it's 2024 now, and the market looks very different. So, Alex, when we're doing our top-down approach, we want to understand the overall landscape. We want to understand some of the intermarket forces at play, and then we want to look at these sector groups to find our leadership areas, what we should be long and what we might want to get short on, or at least underweight. From here, our next step is to dig into those sector groups and further distinguish where that leadership is coming from. So for this week's show, let's talk about utilities. I know it's not the sexiest conversation to have at a cocktail party about which utilities company you might own in your portfolio, but within the utility sector, it's not broad-based all utilities companies. We're seeing an industry group really stand out as the leader that is pulling that sector higher than the benchmark. And that's from electricity companies, correct, Alex?
Absolutely. That's the top panel. So it really is being driven by the relative outperformance by this one subgroup, and that's conventional electricity in the top panel here.
Now, we're human beings, just like the rest of you who are watching this show. And certainly when the narrative makes sense, it's very comforting. and electricity consumption is certainly a trend. Certainly not going to change in the near term as we continue to move towards more and more electric vehicles in this country and a greater reliance on the grid. So, Alex, as we like to do, let's take a look at a couple of electricity utilities companies that have a strong go-no-go formation, some trend continuation, and perhaps some viable dips on the chart. Let's start with NextEra Energy. The ticker symbol is NEE.
Yeah, and you just hit the nail on the head. Some opportunities within that outperforming subgroup, and that's what we're looking at here. We're seeing higher highs. We saw trend continuation when the oscillator rallied off the zero line. We saw that max go-no-go squeeze tip us off to that when we broke out of it into positive territory. That sort of gave us the beginnings then of the new go trend. So we are making higher highs. We see strong go bars, and we've just seen support at the zero line.
Absolutely. That's a good looking chart. Breaking out part of a industry group that is leading a sector which is outperforming the benchmark. Let's take a look at another one. Edison, EIX is the ticker symbol.
Yeah, this one, this one not quite as clean, but you can see that we're getting that surging momentum again as the oscillator is broken back above positive territory. And we're seeing that green continuation icon as go-no-go trend starts to paint those brighter blue bars. Now, obviously on here, we've got a prior high that we'll need to deal with. So we'll watch as it gets close to that level. But at the moment, we're seeing strong blue go bars and positive momentum for Edison.
Fantastic. And one of the things that Alex and I met doing, and one of the things that we love very much is teaching technical analysis. And we had some questions about divergence analysis. And let's pull up one more chart from the healthcare sector. Boston Scientific, BSX is the ticker symbol. And I just want to talk about how we can use go-no-go charts to our advantage, and specifically discussing divergence analysis. Now, let's explain it real quick. It's in a lot of our educational videos, but the idea that if price is trending higher, making a series of new highs, we can look to any number of derivative indicators, momentum, breadth, you name it, and in our lower panels, see whether those are confirming or diverging from that price action. So we have built multiple stochastics and momentum oscillators into the go-no-go oscillator. So we've got a weight of the evidence approach. And you can clearly see a bearish divergence on this chart as Boston Scientific is making a series of higher prices, not a runaway gap formation, but we see that bearish divergence where momentum at each subsequent high is making a lower high on the oscillator. Now, divergence analysis is part scientific and part art. We're interpreting what those market internals are telling us. What I want to encourage all of the viewers on this show is to think about some of those tools that are in your toolkit, things like divergence analysis, and what you do with that information. So certainly we're all seeing that relatively mundane higher approach in price, and perhaps we could understand that might be some trend exhaustion for Boston Scientific. That is not a trade decision, however. And if you were to exit every divergence that you spot between your price panel and anything in your lower panels, that could cause a lot of trouble for you. So remember what I said earlier, price is our most important indicator of all. And for using the GoNoGo trend model as our guide, we want to stick with Go trends. We want to look to these other tools to help us understand some context. And this example is a great one, probably belongs in a textbook somewhere, to show how divergence doesn't always signal the end of a trend. And Alex, walk us through a little bit. We dipped below the zero line on the GoNoGo oscillator and then rallied back to overbought extremes on heavy volume. I'm pretty impressed with this example.
Yeah, it's a great chart. And I think one thing I would add, I mean, you just to hammer the point that you're making home, is that sometimes I think, from having looked at however many charts I've looked at,
Billions,
divergence can reflect trend weakness.
Mm-hmm.
That doesn't mean reversal. So I think sometimes we get a little bit carried away looking for divergence as an example of, oh, it's going to go the other way. Well, if you think about divergence, though, what you're saying is we're seeing waning momentum, right? And that will happen during a trend as people digest moves or as market consolidates. Now, yes, often that leads to a move in the other direction, but only if the trend has changed. So you want to just make sure that you understand that divergence can be a sign of trend weakness, and that trend weakness is shown with the color of the bars changing to the weaker aqua. You can see it here, you see it again here. But as long as, for us as trend followers, as long as the weight of the evidence tells us we're still in a trend, even though we've seen some weakness, that's quite normal. You see it throughout a trend, a rally, and then a consolidation, rally, consolidation. So a weakening trend is like a pay attention moment.
Yep.
Because we could consolidate and go higher, or we could change direction. So it's divergence. Sometimes we want to make sure we think of it in that way as well. It can reflect weakness in a trend. And like you said, the ultimate resolution here was we never fell out of the trend, and then the oscillator regained positive territory on heavy volume, and that preceded a really sort of a new strike to the upside for Boston Scientific.
Absolutely. From all of us at GoNoGo Charts, really appreciate you tuning in each week to this video. You'll find a lot more content on GoNoGoCharts.com. Tell us if you have a chance, either in the comment section below or shoot us an email, info@GoNoGoCharts.com, how you use divergence analysis and where that has helped you in your process. Looking forward to meeting many more of you in the weeks to come. Thanks so much for tuning in. And until next time, take care of each other and trade them well.